So welcome to all of you Shiksha 360. In this session, we will discuss first of all basically simple discussion on the Basel norms. Clear, basically a case study type question on the Basel norms. That is, we have to calculate tier 1, tier 2, capital funds, capital adequacy ratio, or minimum capital. Clear? These types of things we have to discuss, and later on we will discuss some important points regarding the chapter number, regarding the module C. Clear? Regarding the module C. Clear? Basically, that is basically for the revision purpose. So let's start our discussion. First of all, we have to discuss one case study on the module C. Let's start, on the Basel norms. So what it say that basically ABC has paid up capital of rupees 100 crore. Clear? ABC has basically paid up capital of rupees 100 crore. Free reserves of rupees 300 crore. Clear? Free reserve ₹300 crore. Provisions and contingencies. Clear? Provisions and contingencies next to be reserves of rupees 300 crore. Perpetual non-cumulative shares of rupees 400 crore. And subordinated debt of rupees 300 crore. Clear? So if this type of question will be asked in an examination, basically this question is not typical. Very easy question, just we have to differentiate. Clear? Under the chapter number 23, we have already discussed regarding that. Clear? What is tier 1, what is tier 2? Clear? So the risk for credit and operational risk. Clear? The risk for credit and operational risk are 10,000 crore basically for the credit, and the risk for, clear, this is basically for the both. And for market risk, it is to be rupees 4,000 crore. Clear? And for market risk, it is to basically 4,000 crore. So based on the above information, clear, first question which I will asking here, what is the tier 1 capital? Clear? What is the tier 1 capital? Clear? So now let's calculate what is the tier 1 capital basically in this case. Clear? No options, because in this type of question there is not any required of options. Clear? So tier 1 capital. Clear? Tier 1 capital basically it is equal to the paid up capital. Tier 1 capital basically it is equal to the paid up capital plus free reserves. Clear? Paid up capital plus free reserves plus perpetual non-cumulative preference shares. Clear? Plus perpetual non-cumulative preference shares. Clear? Basically these three things are to be included under the tier 1 as per the given information. Clear? As per the given information, that is paid up capital, free reserves, perpetual non-cumulative preferential preference shares. Clear? This thing you have to remember that. Clear? What is included under the tier 1 and what is included under the tier 2. Clear? This depends upon you. Clear? Now just put the value rupees 100 crore plus rupees 300 crore plus rupees provisions and contingencies, not this one. It is basically perpetual non-cumulative 400 crore. So it is to be total 800 crores. Clear? It is to be total 800 crores. Now next question, question number 2 is calculate tier 2 capital. Calculate tier 2 capital. Calculate tier 2 capital. Clear? So what is tier 2 capital? So tier 2 capital basically it is equal to the, as per the given question, that is first of all we have to include the subordinated debt. Subordinate debt under the tier 2 capital. Clear? This one subordinate debt plus how much percentage of the provisions and contingencies reserves. Clear? Basically that is 1.25% plus 1.25% of risk weighted asset, that is provisions and basically for contingency reserve. Clear? Basically for contingency reserve and provisions plus here they have given, that is this one, provisions and reserves, preference shares. Clear? Preference shares. Okay. So now we have to calculate that subordinated debt here. Subordinated debt here is to be how much crore? 300 crore plus 1.25% of risk weighted assets of contingency reserves and provisions. For contingency reserves and provisions, basically 1.25% of which, not this one, clear, this is not of this one, this is not of this one, that is basically this provisions, clear, that is basically for this one and this one, clear, that is risk weighted assets, clear. 1.25% of the risk weighted asset, that is basically for the credit risk, operational risk, and the market risk, clear, and the market risk, clear, for contingency reserves and provision, basically whichever is lower, clear. So basically we have to take 1.25% of what? That is of 14,000, that is risk weighted assets, this one, okay, plus anything we have left, that is this one, clear, that is basically this one. This is to be also known as the revaluation reserves, clear, basically this is also to be known as the revaluation reserves, plus how much percent, that is basically discount here it is on, discount is basically 25%, sorry 55%, discount is basically 55%, so basically we have to take 45% of 300, clear, 45% of 300, clear, we have to take, so 45% of 300, clear, 45% of 300, just you have to remember that subordinated debt plus 1.25% of the risk weighted assets plus 45% of the revaluation reserves, clear, because discount here is to be 55%. So 300 plus 45% of 300 plus 1.25, please left this way, clear, plus 1.25, that is 125 upon 100 into 40,000. So 300 plus 135 plus 125 into 140, clear, 125, sorry, divide by further 100. This cancel out, 25 to 17 plus 175. So it comes out to basically 610 crore, clear, it comes out to basically 610 crore, clear. So this is the tier 2, clear. So in this, first of all, we have to discuss what is tier 1 and what is tier 2, clear. Hope it is clear to all of you basically what is tier 1 capital and what is tier 2 capital, clear. Now next point, clear, now next point which we have to discuss here, clear, now next point which we have to discuss here, that is clear. So one doubt basically from one student, that is sir, revaluation reserves, clear, basically we have to take under the tier 2, clear, we have to take under the tier 2, that is clear, revaluation reserves, okay, and this one basically 1.25% of the risk weighted asset, that is these one operational risk plus all the risk basically what they have mentioned, clear. So please tell fast, both the points are clear to all of you, both the points are clear to all of you. Now move to the next question, clear. Discount, sometimes basically what students face here, basically they will take 55% of 300, note that it is basically 45% because discount is 55%. Now move to the third question under that same question. Number third here is to be 1.5%. It is basically the, as per the theory, basically it is minimum 1.525% of RWA, clear, basically there is not any calculation regarding that, basically you have to remember this one. Now move to the third one. What is the amount of capital fund? What is the amount of capital fund? Amount of capital fund, clear, amount of capital fund, basically it means that tier 1 capital plus tier 2 capital, clear. Tier 1's 800 plus 610, that is 14,1,410 crore, clear, 1,410 crore, that is amount of capital fund. Now move to the next question, question number 4, that is capital adequacy ratio, clear, capital adequacy ratio. Clear? Capital adequacy ratio. What is the capital adequacy ratio? Basically, in this case, clear, capital adequacy ratio, that is, it is equal to the tier 1 plus tier 2 upon risk weighted assets. Clear? Capital adequacy ratio is basically tier 1 plus tier 2 upon risk weighted assets. Clear? Tier 1 upon tier 2, it is basically 1410. Upon a risk weighted, basically it comes out to 14,000. Clear? It comes out to 14,000. So it is a little bit above 10%. Clear? So it is a little bit above 10%. So we will approximately is equal to 10.07. Clear? Approximately it comes out to basically 10.07. Okay. Now last question regarding that. So what is the amount of minimum capital? Amount of minimum capital to support. Clear? Amount of minimum capital basically to support credit and operational risk. Clear? Credit and operational risk. Clear? Amount of minimum capital basically required to support credit and operational risk. Clear? So what is the minimum capital required to support for the credit and operational? That is basically 9%. Clear? 9% of that. 9% of basically what? That is what they mentioned, that is credit and operation risk. Basically it is 10,000. So minimum, that is minimum capital to support basically credit and operation, that is 9% of 10,000 crore. So it comes out to basically 900 crore. Clear? It comes out to basically 900 crore. Clear? So this type of question basically you will get in the examination basically with this information. Clear? With this information. What is the reason behind that to discuss, so that you are able to understand. Clear? Sometimes basically they are given very long type case study. Clear? So just you have to bifurcate the terms from that. Clear? So that you are able to understand the things. Clear? Just you have to understand what they have given and how to formulate the question or how to formulate the answer from the given option. Clear? So in this question we have discussed regarding the tier 1, tier 2, amount of capital fund, capital adequacy ratio, and amount of minimum capital basically to support the credit and operational risk. Clear? To support the credit and operational risk. Clear? Now move to the next question. Next, some important points. Clear? Now we have to discuss important points. Clear? Nothing any discussion. Just basically nothing any like case study type discussion. Very, very important point for the examination point of view. Clear? First of all, here we will discuss regarding the treasury bill. Clear? Treasury bill. So some important points. Clear? So what is treasury bill? Basically they are short-term debt instruments. Clear? What are treasury bill? Basically they are short-term debt instruments. Clear? What are treasury bill? Basically they are short-term debt instruments. Second one here is basically treasury bills. It is to be issued by. Clear? Treasury bills basically they are to be issued by the government of India. Clear? Treasury bills basically they are to be issued by the government of India. You can also share your points if anyone remember regarding that. Clear? I will include also. Clear? Government of India. Third one here basically there are basically 3 tenures under the treasury bill. Clear? Basically there are 3 tenures under the treasury bill, that is 91 days, 182 days, and 364 days. Not 360 days. Clear? Multiply by 2, multiply by 2. Clear? 91 days, 182 days, 364 days. Next one is very, very important. Clear? You will get in the form of in the question, that is treasury bills are basically zero coupon securities. Clear? Treasury bills are basically zero coupon securities. Zero coupon securities basically means that basically it pays no interest. Clear? Pays no interest. Clear? Pays no interest. Clear? Basically they are zero coupon securities and pays no interest. Clear? Pays no interest. And basically why people will do invest in the treasury bill? Basically they are issued at a discount. Clear? They are issued at a discount and redeemed at face value. Clear? And redeemed at face value. Clear? And redeemed at face value. Clear? Issued at discount and redeemed at face value. Clear? What is the meaning of that? Like if we have a treasury bill of ₹100, that is to be face value. So we can say that basically it is issued at 96.50. that on the majority, basically you will get 100 price, clear? You will get 100 price, clear? So what is the return to the investor? Clear here, what is the return to the investor? Clear in this case, what is the return to the investor? So return to the investor, basically difference between the maturity value, or we can say that face value, difference between the maturity value and face value, or and the issue price. Clear, difference between the maturity value or face value and the issue. Clear. So basically this is the return to investors. Clear. So, and basically one student say that basically it is published by FIMMDA. Okay, so basically this is the brief discussion of the Treasury bill. Sometimes basically you will get questions from that. Clear. Sometimes basically you will get definitely questions from that. Like next point which I have discussed with you now, you will get questions from that also. Clear. You will get questions from that also. That is CMB. Clear. On 6th of February, the exam will be conducted on 6th of February 2022. They have asked one more question from the CMB. Clear. CMB. So can anyone tell? Yes, sir. In the next slide, I will discuss the formula regarding that. Clear. Whatever you have written, I have discussed the same. Clear. I have to discuss. So CMB basically stands for, please tell fast if anyone remember. CMB basically stands for cash management bills. Clear. Cash management bills. Clear. So one important point regarding that, basically why it is issued. Why cash management bills? Clear. CMBs are basically issued. Why cash management bills are basically issued? To meet the temporary mismatches. Clear. Basically to meet the temporary mismatches. Meet the temporary mismatches in the cash flow of. Clear. In the cash flow of. Clear. In the cash flow. Clear. To meet the temporary mismatches in the cash flow. Clear. And basically they have characteristics of the Treasury bill, but their tenure. Clear. Basically, but their tenure is less than 91 days. Clear. Basically, but their tenure is basically less than 91 days. Clear. Basically, but their tenure is basically less than 91 days. Clear. So that is basically the discussion regarding that CMBs. Clear. That is basically discussion regarding that the CMB. Now next, basically we have to discuss regarding the some other important points. Clear. Some another important points. So one thing, basically you will get these questions in the form of one mark question. Clear. First is, but what is the full form of STRIPS? STRIPS. Clear. Basically what is the full form of STRIPS? Clear. What is the full form of STRIPS? That is separate. If anyone remember, please tell fast. What is the full form of STRIPS? That is separate trading of. Clear. Separate trading of registered. Separate trading of registered interest and principal of securities. Clear. Separate trading of registered interest and principal of securities. Clear. And principles of securities. Clear. That is basically STRIPS. Now next one important point, basically what is a shut period? SHUT. What is a shut period? Clear. SHUT. Clear. What is a shut period? Basically it means the period. It means the period for which. It means the period basically for which the securities cannot be traded. Clear. Basically it means the period for which the securities cannot be traded. Clear. It means the period for which the securities cannot be traded. That is basically known to be as the shut period. Clear. That is basically known to be as the shut period. Now next one, very, very important point which we have to discuss now regarding the relationship between. Clear. Regarding the relationship between yield and price of bond. Clear. Regarding the relationship between yield and price of bond. Clear. Now basically we have to discuss the relationship between the yield and the price of the bond. Clear? So just you have to tell that basically whether the bond is to be sold at discount or premium or at par. Clear? This is the thing basically you have to tell that. I have to present three cases in front of you. Clear? Just you have to tell that. Clear? Basically whether the, like first one is basically when the market price of the bond. Clear? When the market price of the bond is less than the face value. Clear? When the market price of the bond basically it is less than the face value. Clear? Like face value is to be 1000 and the market price we can say that 900. Clear? Basically when the market price of the bond is less than the face value. Clear? So then the bond basically sells at. Clear? So what is the meaning of that? Clear? Basically when the market price of the bond basically it sell less than the face value, then the bond is at a discount. Clear? Then the bond is at a discount. Clear? The bond is at a discount. Clear? Because this is the market, this is the price, but they are selling at less price. Clear? Basically, but they are selling at less price. That is, we can say that the bond is at a discount. Clear? Basically, bond is at discount. So it means that yield to maturity basically it is greater than the coupon yield. Clear? Yield to maturity basically it is greater than the coupon yield. Clear? In that case, basically yield to maturity basically it is greater than the coupon yield. Clear? Another case, when the market price of the bond. Clear? Basically when the market price of the bond is greater than the face value. Clear? Basically when the market price of the bond it is greater than the face value, it basically means that bond is selling at premium. Clear? Basically bond sells at a premium. Clear? It basically means that bond sells at a premium. Clear? So what is the meaning of that? Is basically coupon yield is more than premium. Sorry, item. Clear? Coupon yield is basically more than item. That is market price of the bond. Clear? That is market price of the bond basically it is more than the face value. Clear? Market price of the bond, that is basically it is more than the face value. Clear? So in that case basically coupon yield it is more than the item. Clear? Third one is basically when the market price of bond. Clear? Basically when the market price of bond is equal to the face value. Clear? When the market price of the bond basically it is equal to the face value. Clear? So what is basically mean that basically the bond sells at par. Clear? The bond sells at par. So basically it means that YTM is equal to coupon yield. Clear? YTM is equal to basically coupon yield. Clear? That is market price of the, that is face value. Clear? Bonds sells at par. Clear? Basically bonds sells at par. That is basically YTM, it is equal to the coupon yield. Okay, now basically we have some doubts in our mind. So what is coupon yield? Clear? So what is a coupon yield? Clear? So now we have to discuss basically what is coupon yield. Clear? So what is coupon yield? Basically it is, I will write it basically it is the coupon payment or coupon payment upon face value. Clear? Coupon payment upon face value. Clear? What is coupon yield? Basically that is coupon payment upon face value. Clear? So coupon yield in simple language we can say that basically it is the coupon payment. It is basically the coupon payment as a percentage of the face value. Clear? Coupon payment as a percentage of the face value. Clear? Coupon payment as a percentage of the face value. Or generally we can say that what is coupon yield? Clear? Basically it generally refers to the nominal interest rate. Clear? Basically it is a refers to the nominal interest payable. Clear? It refers to the nominal interest basically payable on a fixed income security. Clear? Basically on a fixed income security, nominal interest payable on a fixed income security like government securities. Clear? Like government securities. Clear? Example here I will discuss, like coupon here is to basically 8.24. Face value here we have given 1000, sorry 100, and market value we can say that 104 rupees. So what is the coupon yield? Clear? So what is the coupon yield? That is 8.24 upon 100. That is 8.24%. Clear? That is 8.24%. Clear? So this is our answer. That is 8.24%. Clear? Now next we have to discuss here how is the yield. Clear? How is the yield of a treasury bill calculated? Clear? How is the yield of a treasury bill calculated. How is the yield of a treasury bill is calculated? Clear? So how we can calculate the yield of a treasury bill? Yield is equal to 100 minus P upon P. Clear? 100 minus P upon P into 365 upon D into 100. Clear? 100 minus P upon P into 365 upon D into 100. Clear? This is the yield of a treasury bill to be calculated. Clear? So here P is equal to the purchase price. P basically it is equal to the purchase price, and D is equal to the days to maturity. Clear? Basically D is equal to the days to the maturity. Clear? If you just remember basically what I am discussing here, definitely you will get marks in the examination. Clear? Because you will get straight forward questions basically from these things what I am discussing here. Clear? You will get straightforward questions. Clear? In the examination from these points. Clear? Let's discuss one question. And here days to maturity, basically day count. That is basically what is the actual number of days to the maturity. Clear? Actual number of days to the maturity. Clear? Actual number of days to the maturity. Like example, price of a 91-day treasury bill. Clear? Price of a 91-day treasury bill issue at what price? That is 98.20. Clear? Issue at rupees 98.20. The yield would be, the yield on the same would be, that is 100 minus 98.20 upon 98.20. Clear? Upon 98.20 into 365 upon 91 into. Clear? So in this way, the yield is to be calculated. Clear? In this case, the yield is to be calculated. Clear? Now one more question. Please tell fast. It is clear to all of you up to this much point. How to calculate the yield? Clear? How to calculate the yield? That yes, you are right. That is basically it is approximately comes out to basically 7.352%. Clear? 7.352%. Clear? Now one more question on the same. Clear? Now one more question on the same. That is after. We can say that after 41 days, clear? After 41 days, the same treasury bill, clear? After 41 days, the same treasury bill is trading at, clear? After 41 days, the same treasury bill, basically it is trading at rupees 99. Clear? The same treasury bill, basically it is trading at rupees 99. The yield would be. So in that case, the yield would be, clear? After 41 days, the same treasury bill basically is trading at 99. The yield would be, clear? So in that case, the yield would be, that is yield is equal to. So please remember that is, this is two same, that is price into 365. Just it difference after 41 days. Clear? So how many days has to be left? 91 days treasury bill, 41 days gone. Clear? So 50 days are to be left here. So divide it by 50 into 100. So divide it by 50 into 100. Clear? So 1 upon 99 into 365 into 2. Clear? Into 365 into 2. Clear? So please calculate fast. 365 into 2 divided by 99. So that comes out to basically 7.37%. Clear? 7.37%. Clear? So please remember that here basically what is D? Basically D I have already tell days to maturity. Clear? Days to maturity. Here basically they are asking, not given anything difference. Clear? Not anything difference. Clear? That is they are asking calculate what is the yield of a 91-day treasury bill. Clear? Yield of a 91-day treasury bill. That is basically we have to take total 91 days. Clear? Here the value. Here next question basically in relation to that they are saying that after 41 days. Clear? Now 41 days have gone. The same treasury bill. Clear? Now after basically 41 days, the same treasury bill basically it is trading at rupees 99. Clear? After 41 days, the same treasury bill basically it is trading at rupees 99. So in that case, what would be the yield? Clear? So that is yield is equal to 100 minus 99 upon 99. That is 100 minus P upon P into 365 upon D. D here basically that is days to the maturity. So 41 days already have gone. And we have treasury bill it is basically of 91 days. So minus 41 days. So how much days we have left? That is 50 days. Clear? 365 upon 50 into 100. Clear? 100 this one. So on calculation, we will get that is 7.37%. Clear? 7.37%. So please tell fast. Now this point, it is clear to all of you regarding the treasury bill. Clear? regarding the yield of the treasury bill. Please respond fast if you have any doubt, any query regarding that point. Clear? If you have any doubt, any query regarding that point. Hope it is clear to all of you. Clear? Now, basically in the next session, clear? Now in the next session, basically we will discuss same type of discussion. Okay. So basically in the treasury bill, just they have given that, like we can say that either it is to be basically 91 days treasury bill or 182 days treasury bill or 364 days treasury bill. Clear? So on the basis of that, basically in the 182, like we can say that after 110 days. Clear? So just basically they have to change the statement. Clear? You have to understand the concept. Clear? You have to understand the concept. I request to all of you, please try to understand the concept rather than cramming any specific question. Clear? Rather than cramming any specific question, just you have to understand the concept. Clear? If you are able to understand the concept, definitely you will be able to answer the question in the examination. Clear? Definitely you will be able to answer the question in the examination. Clear? Like we have already discussed yesterday regarding the money market, sorry, call or overnight money, notice money, call money, that is basically one working day. Tenure is basically one working day. Clear? Please remember that. One day or one working day. Clear? The correct answer it is to be one working day. Clear? The call money tenure is to be one working day. Notice money it is to be 2 to 14 days. Clear? Notice money it is to basically 2 to 14 days. And term money basically it is to be 15 days to 1 year. Clear? 15 days to 1 year. Okay. Now next which we have to discuss now, that is CD. CD basically stands for certificate of CD basically stands for certificate of deposit. Clear? CD basically stands for the certificate of deposit. Clear? First of all, basically it is a negotiable money market instrument. Clear? It is a negotiable money market instrument. Clear? It is a negotiable money market instrument. Second point, it's basically it's a tenure. It's a tenure is basically 7 days to 1 year. Clear? It's a tenure is basically 7 days to 1 year. Clear? Basically banks can issue certificate of deposit basically maturity from 7 days to 1 year. Clear? Whereas eligible, one another point, basically where are eligible financial institute. Clear? Whereas eligible financial institutions, clear, foreign, sorry, FIs, clear, where eligible for FIs basically can issue basically up to how much maturity, basically for maturities 1 year to 3 year. Clear? Basically where eligible FIs basically can issue for maturities 1 year to 3 year. Clear? Now next one here is basically they can be issued in the dematerialized form. Clear? Basically it is issued in the dematerialized form or a usance promissory note. Clear? Or a usance promissory. Okay, so basically these are some of the important points regarding the certificate of deposits. Clear? Basically these are some of the important points regarding the certificate of deposits. Clear? Certificates of deposits. Clear? In the next session, basically we have to discuss some important points regarding the modified duration, convexity, triparty repo, commercial paper, FBIL. Clear? FBIL. Clear? So basically we have to discuss regarding all these things. Clear? Basically we have to discuss regarding all these things and what is duration, how to calculate the duration, what is yield to maturity, what is bond market, what is money market, Clear? So all these things basically we have to discuss in the upcoming session. Clear? What is accrued interest? Very, very important. Clear? Many students are not able to understand basically what is accrued interest. Clear? So we have to discuss all these points in the next session. Hope what we have discussed in our today's session basically it is you are able to understand all the points and basically it helps you to in the examination. Clear? It helps you in the examination. So thanks to all of you for participating in this session.